I want to explain a little bit more clearly why this matters so much. A lot of the people in Australia who invested in commodity stocks during the previous boom saw a huge chunk of those gains absorbed by the exchange rate, by which I mean that instead of the stocks going up a huge amount, also the currency went up a huge amount. If you're a UK investor who invests in Australian commodity producing companies, you get the benefit of both. You get the rising share price and the rising exchange rate, which increases your returns. So you're not focused on the US dollar then as a hedge to reduce the risk. For example, if there's some sort of crisis, commodities go down, but the US dollar goes up, which cancels out the losses.
Yeah, I mean, this is one thing I love about this market, because you could actually invest in a company on the, let's say, the ASX, and the share price does nothing, but the FX moves, and so you make money. Likewise, you know, the shares could, they could go down and the FX moves in your favor, and you can still make money. And so it's a really interesting market. And you're absolutely right. You need to look at both the foreign exchange rate and the commodity and the company. And what I tend to find is a producer, because they're actually producing the commodity, tends to move more in line. The share price tends to move more in line with the movements in the commodity price, underlying commodity price. Whereas an explorer, even if the commodity price goes down, if they find a lot more of whatever they're looking for, the price can explode. I told my subscribers about a company called Chalice last year, and that went from 15.5 cents to over $9. Now, clearly, that was a particularly fantastic story, but that's what can happen when you pick the right companies.